the last 12 months, 18 months, maybe for eternity, there is never a dull moment if you are indeed looking at the Indian financial space. Stressed assets, missed repayment schedules, and now a new PSU banks merger in the works. Add to that RBI's recent spring cleaning drive in the private banking space. And a lot of these factors have had a huge bearing on ratings as well, which turn influence investments too. So let's pick up some of these factors and the bearing that will have on ratings, and how do people within the rating agency companies view some of these developments. Saswata Guha is director at Fitch Ratings India, joins us right now on the show to talk about all of this and more. Saswata, good morning. Thank you so much for joining in. This is Niraj here. A couple of things that I really wanted to talk about. One was this latest developments in the private banking space, and Yes Bank is right in the thick of things. The other is the whole PSU banking space. Yesterday, Finance Minister Arun Jaitley has come out and said that there will be effective action taken against frauds, willful defaults, and NPAs within the PSU banks are reducing, cleanup is happening. How are you guys watching at all of these developments within the PSU banking space? And do you believe that that entire lot is a much better lot right now than what it was, say, maybe 12 months ago, or not quite?
Right. Good morning again. Well, as you said, I mean, I totally agree that it's never a dull moment in this space, and you're right to point out the issues which are currently obviously have been plaguing the PSU sector, but also now the private sector banks. I mean, let me just say that at the outset that governance is one of the key areas, or rather very important area that goes into our rating framework. And generally, the view has been that governance at PSU banks, because of the excessive influence of the government in terms of day-to-day matters, and also to an extent on the board, obviously does impact or has been impacting the governance at PSU banks. But what we are seeing of late, particularly in the private sector, have also sort of raised certain concerns in terms of how the management and the board has conducted itself in terms of particularly the asset quality issues. And what we're seeing essentially in that sector, and I won't just single out Yes, but I think the RBI has taken rather fairly strict action in various cases. And what we're seeing is that the RBI, one, is well within its powers to do that, and two is, I think it's increasingly now upping the ante and asking for greater accountability from these banks. What has been a bit bemusing to us is that why the RBI has not been able to exercise similar influence on PSU banks, which arguably have been in a lot more stress and a lot longer in comparison to the private sector banks. Now, coming to your other question in terms of our public sector banks looking less weaker, well, the fact of the matter is we still have about 11 PSU banks which are under RBI's prompt corrective framework, and there are approximately 6 more banks which are pretty much out of the game, because although they may not be under PCA, but they are in breach of at least one or other risk threshold of that framework, which effectively means that their ability to pursue meaningful growth is completely out of the window for now. So I think you have a lot of 20 banks, of which 17 are not growing or are growing very, very in smaller numbers, which goes to show that clearly they're not out of the woods. But what I would say is that if you look at the asset quality problem now compared to perhaps 2 years back, I think thanks to the various interventions by the RBI in terms of asset quality review and NCLT and so on and so forth, I think a lot of the legacy problems are now out in the open in comparison to what they were perhaps 2 years back. But still, I think the huge baggage of bad loans that the PSU banks carry continues to be a big overhang on their overall operations, including their earnings. And until and unless they are able to resolve that, I don't necessarily see them coming out in green very soon. And to do all of that, let's be mindful that it needs capital. So on balance, I think The problems are certainly now a lot more in the open, but I think the PSU banks continue to be very weak.
Just wondering though, I mean, the FM has said after this PSU banks review meet that bad loans are declining and recoveries are picking up. I know until now in the reported numbers, we haven't seen any visible impact, a large visible impact thereof. But in your conversations with banks, are they echoing a similar sentiment? Are you seeing evidence of this?
Well, I think that's the general message that we even get to hear. But I think if you look at say for example, the potential watch list, loans for many of these banks, I think many banks are still reporting watch list loans in the range of anywhere between 1.5% to 2%. And if you see the kind of migration from watch list to NPLs in the last few quarters, I think the number has been in excess of 80%. So I think there is still some element of risk that is there in those balance sheets. The question really is that when do these ratios, or when do the numbers actually turn on a sustainable basis? And for that to happen, I think many of these banks which do not have capital or very, very poorly capitalized today, I think they need that excess capital to be able to pursue recovery at a faster pace. That's one. And then for certain banks which perhaps may be in a better position to grow in comparison to others, I think that growth also needs to sort of kick in for the ratios to start moving downwards. What we are seeing is still a very sort of mixed performance. It's not secular across the board. So I would probably wait and give it at least until the end of this financial year before making a claim that things have finally turned.
What did you make of the outcome of the board meeting at Yes Bank? And I know all of that is subject to the RBI approvals, maybe even the second largest promoter shareholder Madhu Kapoor, and I don't know what that camp's view is on all of this, but how are you viewing what's happened in Yes Bank from the time the first piece of news came out until yesterday?
Yes. Well, see, I mean, Yes Bank is a large professionally run organization. It is a listed company, has a lot of stakeholders, and I would expect any kind of change in leadership must be in the interest, one of the obviously the shareholders and the creditors, and two, should be done in a way which is least disruptive. And in that sense, the press release put out by the board of Yes Bank, where they have talked about seeking approval from the RBI for an extension, does not seem to be out of place. I think they're well within their ambit to do that. Of course, the ball subsequently will be in RBI's court, and I think the final decision will rest with the regulator. But I think if the board thinks that a little more time is required to ensure that the transition is well managed, then I think it is not unreasonable.
Okay, let's wait and watch if the RBI is in that camp or no, or whether it views it that way or no. But okay, I get your point. Saswata, my final piece will be, or final query really would be on the larger financial space, the NBFCs, and this whole issue surrounding the liquidity in certain camps. I don't know if the ratings of some of these bonds have been coming off or no. Of course, Indiabulls Housing Finance has released a slew of announcements on the BSE speaking about how the ratings of their paper seems to be on track. DHF has also said so. But because of liquidity or otherwise, and because of the financial health of some of these banks, because growth capital might not be there, so on and so forth, if indeed the valuations have come off, is there a worry from either a rating perspective or just from a watching perspective of the finances or the health of some of these NBFCs?
Yes. Well, if you see the public disclosures of many of these banks, I think the NBFC started featuring in their so-called watch list sectors for quite a few quarters back. So clearly there have been concerns on the sector as a whole. What an event like ILFS and subsequently, what we saw in terms of the market tumbling and a particular share price, I mean, that basically highlights the kind of vulnerability that NBFCs face on the funding side, which can get accentuated very fast and sort of start looking like a contagion when an event of this magnitude happens. But from a rating perspective, I think funding and liquidity from our scheme of things is one of the most key factors in terms of rating NBFIs, and we think that particularly NBFIs which have been growing very, very fast. In general, I think the NBFI sector growth has been quite robust, but I think there are players which are growing in excess of 1.5, 2 times that of the industry average. And in some of those entities, you would see there's been a secular shift in terms of funding towards the short term. I think those are the guys which are really exposed to potential increase in funding costs. I don't yet think the market is going to shut them out, but would that impact NIMs going forward given the recent events? The answer in my opinion is yes.
To your mind, is the impact largely on NIMs alone? Various people that I speak to say that there is not a liquidity risk in the system. There is probably a risk for 2 or 3 of these NBFCs which will not translate into the whole space. But is that your reading as well? And therefore part 2 or part 1 of my question, that all that's happened in the recent past, do you believe that the biggest takeaway from all of that is that liquidity will not be a problem, but the net interest margins for some of these and maybe the growth capital for some of these NBFCs will be a problem?
Well, liquidity in my opinion is certainly a problem, and it's been a problem for some time, only accentuated by the OMOs and a couple of other things. So I think there are various market estimates out there, some ranging as high from 1.5 lakh crore to 2 lakh crore worth of deficit. But the point is not that. I think some of the larger NBFIs, the marquee names, will continue to be able to refinance themselves. The question is really at what price, and whether they are able to sort of transmit that to the end borrower. Given that many of these institutions have fairly long-ended asset portfolios, my sense would be that the immediate impact would be on the NIMs. For the smaller ones or the less reputed ones, obviously there is a question mark, because ultimately you have to understand that the NBFI as a sector relies primarily on banks, which, as you rightly pointed earlier, that they themselves are sort of have been in a cautious mode for some time, and 2 is obviously the capital markets, where yields have just gone off the roof. So from that perspective, if you see, I think the immediate impact, in my opinion, is going to be on the liquidity front, and that would reflect through funding costs. But yes, if subsequently significant asset quality concerns also start surfacing, as I said, that many of these NBFIs have been growing at a fairly brisk pace for the last 3 to 4 years, I think then that would obviously add to the concerns of the market, but we'll obviously have to wait and see if that really happens. But for now, I think NIM is essentially what will be at risk.
Saswata, really appreciate you taking the time out and joining us and speaking on what is arguably the top of the mind of the market right now as well. Thanks for your time.